heard it, debacle. That's how PIMCO CEO Mohamed El Erian describes the Irish banking situation. Well, the cost of the country's bailout is set to hit 100 billion euros after the government said banks needed an extra 24 billion in capital. Well, meanwhile, in Portugal, the government will attempt to sell 1.5 billion euros in bonds later today as it tries to avoid running out of cash. Now, 10-year bond yields surged to a record this week. They are up more than 40% in the last 4 months. Well, our next guest says Portugal could go broke within a matter of weeks. Antonio Garcia Pascual is Chief Southern European Economist at Barclays, and he joins me now in the studio. Thank you so much for joining us. How concerned are you that the situation for Portugal will get worse instead of getting better? We will have elections on the 5th of June. It gives very little time to the government to actually renegotiate any kind of bailout. And today we have this extraordinary bond auction.
Yes, indeed. I think the key issue possibly is the political precariousness of the situation. As you know, there's elections on the June 5th, the 5th of June, and in our view, basically, most likely, a program will be negotiated with a new government that will be post June 5th. That will be a government with more legitimacy to actually go ahead and negotiate with both the IMF and the EU.
But you also believe that actually Portugal doesn't have enough money to fund itself for June.
True, this is the issue, but we think that the government probably has sufficient cash to go throughout April and May funding needs. In June, however, there is an important maturity and there is an important accumulation also of deficit, but we think that the government is likely to get some form of bridge funding over that particular month. Remember, it doesn't
this would be through the IMF?
Well, I think the IMF-EU funding is likely to come once the new government is in place and negotiations are taken with the new government. That's our baseline.
And so once they ask for this bridge fund, of course, then they'll have to ask for a bailout.
We think that this is the most likely scenario at this stage. It is unlikely that the negative market dynamics can be reversed.
Talk to me about this extraordinary bond auction. It seems like a huge gamble if there's not enough appetite from investors for this today. Is it likely that actually they have some kind of pre-agreement with either local banks or Brazil?
This is difficult to say, of course, for us, but we think that the government has to go on and carry on with the plans to issue T-bills and to issue bonds, and they have to try the market appetite. As we mentioned, they're in a tight cash position, and it's the duty to try to attempt and tap the markets. Otherwise, there might be other alternative credit lines, and they might be in a sort of a more extreme scenario. They will try then to negotiate a program with IMF. We think this is a less preferred option.
You know, we also seem to, if we look at the markets, we seem to understand that the markets doesn't believe that the crisis will spread to Spain. Is this a big gamble? Is this something that actually you'd be very wary of?
This is the key point, because if you think about the size of Spain within the EU, it is the one that actually drives contagion for the rest of the monetary union. So you're right. This is the key issue. The markets seem to have delink or decouple Spain a little bit from the other three peripheral countries. In our opinion, in part with some good reason, because the government has been taking more or less the right steps forward. There is one issue, however, in Spain, which is pending the sufficient recapitalization of the cajas, which we think is likely to be of a larger order of magnitude than the government says.
And I know you don't really cover Ireland per se in terms of country, but of course the fact that now we seem to be having the Irish government retracting from putting any pain on bondholders, does it also change your view on the southern peripheral countries?
Well, let me qualify a little bit that. I think that the Irish government have mentioned that they do intend to put burden sharing among junior debt holders. Okay? And I think this is important. It's important because of fairness. It's important to help basically mitigate the fiscal consolidation. They have indicated that senior debt holders in the 4 banks that participate in the stress test will not suffer burden sharing. I think this is also a positive for the market. They note that they left outside the Anglo-Irish and IMBS, the 2 banks that are non-viable.
Antonio Garcia Pascual, thank you so much.